Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, November 22nd, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, where is the global economy headed? Our answers are in the wrong direction, at least according to the preliminary November PMI data from several of the world's major economies. The data generally indicate a few things that are all negative from the perspective of global liquidity. Number one, the global manufacturing downturn deepened. Number two, the global manufacturing downturn may be spreading to the global services sector, which is a much larger share of global GDP at 62% versus 26% for manufacturing. And number three, U.S. exceptionalism may be breaching a critical threshold that begins to curtail global liquidity via unimpeded uptrend in the U.S. dollar, most recently having occurred in 2022. Transitioning to our 42 macro dashboard, as always, I'll wrap up with a question from our community. This one's regarding the KISS construction and fundamentals. It says, Skipper, in this morning's lit off morning note, I'm going to make a wallpaper out of this one and paste it on my wall. It says, great companies can make terrible stocks, while terrible companies can have great stocks for extended periods of time. As such, the peak of NVIDIA will likely have far less to do with company fundamentals and a lot more to do with global macro flows. That is a highly likely outcome, and our structural passive flows exceed active flows regime. Is this why KISS is built with a tiny handful of ETFs instead of more specific stock ETF and individual stocks? Because it's hard to pick such specific investments, and fundamentals have flown out the window. So that's certainly a contributory factor in terms of why we focused our KISS portfolio construction process, which is a 60-30-10 trend following strategy featuring SPY, IAU for gold, and FBTC for Bitcoin. So just 3 ETFs at any given time, in terms of those 60-30-10 allocations, which dial up and dial down based on our trend following signals. And so, why we decide to go with something simple. One, it's easier to execute than having like 10, 20 different stocks and ETFs out there. But the most important reason why we have simplified KISS for our retail investor audience, which is you don't have to go out there and generate alpha. Generating alpha is by far the hardest thing to do in finance. You, as a retail investor, have this great sort of benefit that institutional investors don't have, in the sense that you can get paid to collect beta. Institutional investors can't get paid to collect beta. They have to generate alpha. That's how they earn their fees and growth in their AUM. You, as a retail investor, can just participate in the broad market return and actually use that to pull yourself closer to retiring on time and comfortably. So that's why we focus KISS on that, because we understand that most retail investors can't even collect beta. A lot of times they're sitting on the sidelines watching the markets go up, 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 and up and away, because they've been convinced by some, charlatan bear porn newsletter writer that they should be sitting on the sidelines and or short the market. And 9 times out of 10, that's idiotic advice. The market generally goes up over time, as institutional investors like myself understand. And generally speaking, we're generally bullish, unless there's, KISS, or our social risk management overlay, Dr. Mo, tells us to take down risk to manage risk. You do have to take down risk to manage risk a couple of times a year on average, to kind of stay on the right side of market risk. But generally speaking, markets go up over time. So we built our systematic KISS portfolio construction process to keep retail investors engaged and participating in markets that generally go up over time, and ultimately, managing risk in those moments where it's time to manage risk. So hopefully that's a good explanation of why we have simplified investing for thousands of retail investors around the world vis-a-vis our KISS portfolio construction process, which I use to manage my entire liquid net worth. And I can confirm KISS is fantastic. It works, and you should definitely give it a try. So we'll wrap it up there. Everyone have a wonderful weekend. We'll catch you back here on Monday. Cheers.